Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. In this video, we'll cover several questions from Chapter 9, Partnerships, Formation, Operation, and Basis. So we'll jump right into this first question, and it's asking us to indicate what is the difference between a general partnership and a limited liability company, and when might each type of entity be used by completing the table below. Classify each characteristic as belonging to a general partnership, a limited liability company, or both a general partnership and limited liability company. All right, so there's several types of partnerships, and each is suited obviously for different types of situations. As it relates to partnerships, these entities are defined and formed under the state law, and they're typically distinguished based on the type of business that's permitted to be conducted by the entity. And this includes to the extent to which the partners, they're allowed to participate in management, in addition to the extent to which the partners are personally liable for the entity's debts. So here it states partners are considered members for A. When we have a limited liability company, the owners are called members, and limited liability companies often referred to as LLCs. These are like a hybrid type of a partnership. In a partnership, they're called partners. In an LLC, they are called members, but essentially, generally the same thing. So under an LLC, they call them members. And the reason being is because if you have a single member LLC, it's similar to a sole proprietorship. However, there's limited liability protection. And then when there's more than one individual, if there's no LLC, it would be a partnership. But under an LLC, it's called a multi-member LLC. So we move on to B. B states permitted to participate in the management of the entity. So as it relates to the partnership, there's a classification of partners. They can either be a general partner or they can be limited partners. So it's very important to distinguish between the two. Reason being, general partners, they participate in managing the entity. And one of the downsides is that the general partner can be legally required to pay any partnership recourse debt. Limited partners, on the other hand, they're typically not permitted to participate in entities' management. Hence, they're not liable for partnership debts, except to the extent that the partner owes any unpaid contributions to the partnership. So it doesn't matter if you have a general partnership or a limited liability company. In both of these, you would have what's called general partners. So this applies to both general partnership and limited liability company, because with each structure of a partnership, there needs to be at least one general partner. Here we have creditors collect from both the partnership assets and the partners. So that's why a lot of times individuals will decide to create an LLC, because they essentially want to be able to shield themselves. Then we also have what's called a limited liability partnership, an LLP. This is like for professionals like doctors, accountants, etc. They don't want to be held liable for the misconduct of another partner. But, that's obviously not one of the answer choices. So the correct answer for this would be a general partnership. Under a general partnership, the individual is going to, the creditors rather, they will have the opportunity, unfortunately, let's say, God forbid, the partnership is sued and the partnership doesn't have enough money, they can come after the assets of the partner. D states the partners have unlimited liability for the entity's debt. This is also a characteristic of a general partnership, because we know with an LLC, the liability is limited, hence the name. E, it states absent a personal guarantee, there's no liability for the entity's debt. As I just referenced, this is one of the characteristics of a limited liability company. F states usually used for corporate joint ventures where the corporate partners are established with limited assets. This is a general partnership. So again, for those of you who decide, hey, I love taxation, I want to venture into taxation, these are the areas where you can provide the most value to clients, individuals, and those who want to venture into business, because the structure in which you set up a company ultimately determines, the amount of taxes you'll have to pay. It determines the forms you'll need to file, the liability that you are exposing yourself to. So you want to be able to understand the nuances, the advantages and the disadvantages of the various business structures. We've learned in the previous chapters about corporations, and in this chapter we're learning about partnerships, and later down the line we'll learn about S corporations. Again, you want to solidify your understanding on the advantages and disadvantages of each so you can assist clients to make decisions that best suit their vision for the business. And a great thing is that, let's say the business is expanding, there are some provisions in the law whereby you can change the tax structure. The basis of the entity will stay the same, but for tax purposes, you can shift things around. So again, definitely important to solidify your understanding. This brings us to the next question. Here it asks us, how does a partnership report its income for tax purposes? Who makes most elections related to partnership income and deductions? As we've learned, there are two tax-paying entities in the federal tax system. The first are individuals. The second are corporations. What that simply means is that the individual and the corporation, they file tax returns and pay taxes at the individual and at the corporate level. On the other hand, we have what's called pass-through entities. Pass-through entities are also referred to as flow-through entities. And what that simply means is that there are no taxes at the partnership level. There's no taxes at the S corporation level. Instead, the income, the expenses, the deductions, credits, gains, losses, etc., they pass through, they flow through to a tax-paying entity, which is either the individual or the corporation. So a partnership is not a tax-paying entity. However, partnerships are required to file an informational return, and this is reported on Form 1065. So the partnership reports its income and expenses on Form 1065. So we'll go through it. In keeping with the entity concept, a partnership must file, again, it's not a tax reporting, but it's an informational return, and the form is Form 1065. So the partnership income consists of income from operations in addition to any separately stated income and expenses. The income and the expenses from operating activities, you would see those on page 1 of Form 1065. And then if there's any separately stated item, whether it's an income or expense, the reason why it's considered separately stated is because it affects the tax liabilities of different partners. So let's say, for example, there's charitable contributions. One partner claims itemized deductions, so he'll get the benefit of the charitable contributions, versus another partner that takes the standard deduction. They won't get the benefit of the charitable contribution. Another example, capital gains. Capital gains is either 0%, 10%, or 0%, 15%, or 20%, ultimately depending on the partner's income or the member's income, if we're referring to it as Schedule C. So the key thing is, again, it might affect them differently depending on their level of income. One partner might be subjected to 0% capital gains tax, another might be subjected to 15, another 20. It varies, right? It's not necessarily the same. So those separately stated items would be reported in the partnership return on Schedule K. So we move on to the next sentence. It says, on this return, blank makes the most elections regarding the treatment of partnerships item, and blank is calculated. So generally, the partnership makes most of the elections. The partner does make some elections, but for the most part, it's the partnership that makes most of the elections. And there's no tax calculated because, again, the tax is passed through to the partners or the members if it is an LLC. There are some nuances where there's an exception if there's like a built-in gains property contributed to the partnership, but those are in certain rare cases. So there might be a partnership tax, but again, there's very limited situations where that would take place. Next, it states, what two theories underlie most partnership tax rules? As an example, Contrast the theories underlying the treatments of the business interest expense limitation and the qualified business income deduction. So for business interest expense, it is the partnership that determines whether the 30% or the 50% deduction limitation under Section 163J applies. If there's treatment of the carryover at the partner level, and it is consistent with what's called the aggregate theory. Next, here it states the blank calculates the Section 199A qualified business income. So it is the partner that calculates the Section 199A qualified business income. The partnership, however, needs to calculate and report the necessary information. And then from there, the partners are going to need to calculate any limitation on the deduction. And this treatment is consistent with the aggregate theory. So the unique tax treatment of partners and partnerships, it can be traced to two legal concepts. We have the first one, which is the aggregate or the conduit concept, and then we have what's called the entity concept. So under the aggregate or the conduit concept, simply stated, this treats the partnership as a channel, right, through which essentially the income, credits, deductions, and other items, they flow through to the partner. So if you think of a conduit, it's basically creating a space to connect to something else. The partnership is regarded as a collection of taxpayers joined together in a relationship, and then essentially the information, income, deductions, gains, losses, etc., it flows through to the partners individually. Next, we have what's called the entity concept, and this treats partners and partnerships as separate units and gives the partnership its own tax personality. So for example, the partnership needs to file an information return that summarizes activities for the year. So this brings us to the end of this question. And again, these are the two different concepts. We have the entity concept, and then we have the aggregate concept. So with this next question, it says, considering the differences and similarities between provisions, section 721, non-recognition gain or loss on contributions to a partnership, and section 351, corporate formation, and it's asking us to refer to chapter 4 for the non-recognition provisions related to corporate formation. So as we learn with partnerships, section 351, this is essentially when individuals are transferring property to a corporation. They only receive stock, and in addition, they are in control of the corporation immediately after the exchange, which means that they own at least 80% of the corporation. So kind of similar, right? Because let's say I started a corporation, I own a building, and then I transfer the building to a corporation that I own 100%. I basically still have ownership, right? But instead of me owning it personally under my individual name, it's now owned by the corporation, which I own 100% essentially. So in such case, with section 351, there's a deferral, a postponement of gain. The same applies with section 721 for partnership. So A states, non-recognition of gain or loss on contributions applies only if those persons transferring property to the entity are in control of the entity immediately after the exchange. This applies to section 351. Under section 721, control is not a requirement. B states, non-recognition of gain or loss on contributions applies to initial transfers as well as all subsequent contributions to the entity. So under section 351, as we know, there's no gain or loss recognized if the property is transferred to a corporation, either upon the creation of a new corporation or an existing corporation. And section 721 provides as a general rule that neither the partner nor the partnership recognizes any realized gain or loss that essentially results whenever the partner contributes property to the partnership. And this applies when the property is contributed in exchange for partnership interest upon formation, or if the contribution occurs at a later date. Hence, for B, this applies to both Section 351 for corporations, and Section 721 for partnerships. C states, if the transfer of property involves the receipt of money or other consideration, the transaction may be deemed a sale or exchange rather than a tax-free transfer. Under Section 721, the contributor needs to receive an interest in the partnership, whereas under Section 351, the transferor needs to receive stock in the corporation. So under both Section 721 and Section 351, the transfer of property involves the receipt of money or other consideration, and the transaction may be deemed a sale or exchange rather than a tax-free transfer. So again, there are some situations where Uncle Sam might decide, hey, it seems as though they are trying to mask it as a tax-free transfer when this is really a sale or exchange. Last one, D states non-recognition provisions do not apply to all transfers made by the owners. So there are some similarities that exist between Section 721 and Section 351 in that these non-recognition provisions, they don't apply to all transfers made by owners. There are certain transactions under both provisions that require the recognition or gain or loss. So when it comes to Section 351, if they receive boot, in such case, the shareholder is going to need to recognize boot, the lesser of, the gain realized, or the fair market value of the boot. So there are some nuances to which the non-recognition rules will not apply. All right, so this brings us to our next question. It says, select for each of the following: either yes, it is a guaranteed payment, or no, it is not a guaranteed payment. So in this section, one key thing to keep in mind is that sometimes partnerships, they make payment to a partner, right? And sometimes the partnership might take out distributions and things of that nature. And it's very important to distinguish between the two. The guaranteed payment is an amount that's paid to the partner for performance or service, or for use of the partner's capital, versus if the individual, the partnership, is taking a distribution. Distributions, unfortunately, they reduce the basis for the partner, but they are not considered deductible. So something important to keep in mind. So an amount paid to a partner for the performance of services, yes, this is considered a guaranteed payment. Here it says an amount paid each year to the partner as a return on their investment in the partnership. So the partner's Schedule K1 indicates whether the guaranteed payment is for services or capital. But one of the key things to keep in mind is that for the guaranteed payment, this cannot be based on the partner's investment, right? It's essentially for performance of services or for the use of the partner's capital, not a return on their investment. So this would be no. 3 states an amount paid that is comparable to the salary or interest payment. Guaranteed payments, they resemble the salary or interest payments of other businesses. So this would be yes. Payments that are generally not deductible. So the partnership would either deduct or capitalize the payment depending on its nature. So this would be no. 5 states payments that can result in a loss to the entity. This would be yes. Deductible guaranteed payments, it's just like any other deductible expense of a partnership. It can create an ordinary loss for the entity. And if the partnership distributes appreciated property to pay the guaranteed payment, then in such cases, the partnership is going to need to recognize a gain on the transfer. So we move on to Part B. And Part B is asking us to complete the statements below regarding the reporting of guaranteed payments on Form 1065 and its various schedules. So guaranteed payments, are they deducted, not deducted? Guaranteed payments are deducted on Form 1065, page 1, or they're capitalized if the payment relates to an underlying partnership asset. Here it states these amounts are also shown on K1, Schedule K, Schedule M. So keep in mind, with Schedule K, Schedule K reports all of the separately stated items. So this will be scheduled on Schedule K because it will be separately stated, and then it will be reported individually for each partner on Schedule K1 as an item that must be allocated to the partners for them to report as ordinary income. Therefore, in the partnership's book to tax reconciliation, it could be on Schedule M1 or M3. It ultimately depends on the assets that the company has. If the assets are $250,000 or less, they don't even need to prepare it. But in the event that the partnership does, because it's just good practice too, especially if they have good books and records, why not? Right? So with the M1, we would report it. And then if, let's say, the income is more than 10 million, there's a specific provision, then in such case, the partnership would need to prepare Schedule M3, which is a more detailed version. So our answer choice would be both because, some partnerships are different. In such case, the guaranteed payments are added back to book income so that the two measures of the partnership income can be equal. Next, we move on to C. It asks us to complete the statement below regarding the reporting of guaranteed payments and taxes to the partner, including taxes other than income taxes. So the amount that's received by a partner as guaranteed payment is shown on that partner's, it's shown on their K1, right? They don't get a W-2. They're not an employee. A partner cannot be an employee of a partnership. It's not shown on M1 or M3, as we just pointed out. M1 and M3, that basically is the reconciliation for book to tax income. It will be on Schedule K1, which is the form that the partner receives or the member receives from the partnership, which shows their share of income, deductions, etc. And it will be reported by the partner as ordinary income. For D, it states, complete the statement below regarding the ways in which the tax treatment of a guaranteed payment for services differ for guaranteed payments for use of the partner's capital. A guaranteed payment the partner receives for contributing capital to the partnership, unfortunately, it's not eligible for the Section 199A, the qualified business income deduction. And it is potentially subjected to the net investment income tax, but generally it is not subjected to self-employment tax. So again, these are some things that you want to make sure that you understand. So that way, as you advise clients, they have a good idea of how the decision that they are making to set up a partnership or to form a partnership, the impact that it will have. Here we see E. It states, when preparing a partnership return for a client, how do you think you can determine the classification of its guaranteed payments, whether it's services or capital? So when preparing a partnership tax return, you may be called upon to classify the guaranteed payments for services versus payments for capital, because obviously they are treated a little differently. All right, so again, you definitely want to keep these things in mind, not just for tax preparation purposes, but also for tax planning purposes. We move on to our next question. Here it asks us to answer the following questions regarding a partner's capital account. The first question, part A, asks, what is a partner's capital account? What methods can be used to determine the capital account? And when might these methods be used? So as it relates to the partner's capital account, one of the key things is that this is ultimately helping to determine, it's like a form of accounting pretty much, right? How much did the partner contribute? How much did they take out in distributions, etc. So a partner's capital account can be thought of a list of separately stated items, an accounting of a permanent record. It would be an accounting of the partner's ownership in the entity. So much like in accounting, let's say we are dealing with a sole proprietor and you want to determine their equity in the corporation, it's fairly similar. How much did they initially contribute? How much did they distribute? The net income would have an increasing effect on the capital. Losses would have a negative effect, etc. So a partner's capital account reflects the partner's Is it their financial interest, original basis, retained earnings? Retained earnings are for corporations that wouldn't apply. It doesn't show their original basis, but it shows their financial interest in the partnership. And it is determined using one of several possible methods defined by the partnership. The partner's ending capital account is rarely the same amount as the partner's basis. Very important to keep that in mind. There is a difference between the capital account and the partner's basis in the entity. All right. So the partnership basis rules, there's some reasons behind it. And the key reason this single taxation of partnership income is possible is because of the partnership basis rules. So a partnership has an inside basis for all of the assets it owns, and the partner has an outside basis in the partnership interest. So in general, the partnership basic rules follows the aggregate concept, and this ensures that the partnership's total outside basis basically equals the sum of all of the partners' outside basis. So definitely something you want to keep in mind. And as it relates to the capital interest, that's basically measured by whatever the partner's capital sharing ratio is. And that is what the partner's percentage ownership of the capital of the partnership is. So long story short, this is, or to make it easier rather, this will be the share of capital that the partner would receive if the entity was liquidated. Hence, that's why this answer here is the financial interest. So this brings us to the last sentence. It says a tax basis capital account might be used if the partnership is blank, otherwise required to prepare financial reporting information. So this would be if it is not required to prepare financial reporting information. So now we move on to B, and it asks us to select yes or no to indicate whether the following are included in a partner's ending capital account balance and which are not. The capital account reflects contributions and distributions of cash or other property to or from the partner. Yes, this will be included. The capital account accumulates the partner's share of increases and decreases from operations. This is yes. Here it states the capital account may be adjusted for the partner's share of partnership liabilities. No. 4, the capital account excludes income or expense items that are otherwise tax exempt or non-deductible. This is also no. All right. So obviously, as we see that, there are some nuances. Some things impact the capital account and other things impact the basis. You want to be able to differentiate between what impacts what. So here it asks, where can you find a partner's capital account information? So the ending capital on the K1 plus or minus the partner's share of partnership liabilities will often equal the partner's tax basis. So it will be the ending capital plus the partner's share of partnership liabilities will often equal the partner's tax basis in the partnership entry. As a corollary, the partner's tax basis capital account doesn't include partnership liabilities. In such case, it does not. So the partner's tax basis capital account does not include the partnership liabilities, but the partner's tax basis in the partnership interest does. So similar to what I just mentioned, not too long ago, you want to make sure that you can understand the difference between what impacts the capital account and what impacts the tax basis as it relates to the partner's interest in the partnership. Moving on to our next question. Here it states, complete the email below by classifying each of the situations as an advantage of partnership or a disadvantage of partnership over operating as a C corporation or S corporation. So this is to Liang Industries from Shelley Newlands. The date is February 1st, 2025. The subject is advantages and disadvantages of a partnership compared to a C corporation. You have asked when a partnership might be more or less advantageous than a C corporation. Below are several situations to consider. So A states, if the entity plans to distribute its excess cash flow to the owners on a regular basis. This would be an advantage of a partnership. So a partnership is more advantageous to a C corporation whenever the entity wants to distribute excess cash flow to the owners on a regular basis. The reason being is because essentially with a C corporation, they would need to distribute dividends. And the challenge with that is that the corporations are subjected to double taxation. There's income at the corporate tax rate, plus there's dividends when excess cash is distributed to shareholders. So this is one of the challenges. This is actually a disadvantage of a C corporation. However, this advantage is even more pronounced if the owner's marginal tax rates are lower than the C corporation tax rate. We move on to B, where it states if the entity owners are individuals and the income will be eligible for the qualified business income deduction. This will be an advantage of a partnership, reason being the qualified business income deduction, it is not available for C corporations. The qualified business income deduction governed by Section 199A, this was actually put into place to compensate for the fact that C corporations are no longer on a progressive tax rate. Instead, the flat corporate tax rate is 21%, but not all businesses operate as a C corporation. Hence, Congress enacted Section 199A to account for non-corporate taxpayers. C, if the entity currently operates as a C corporation and has substantial built-in gains on its assets, this would be a disadvantage of a partnership. As mentioned, with the partnership, generally, the partner and the partnership and the partners will not recognize any gain or loss, but there is a nuance when there are built-in gains on property. So the entity currently operates as a C corporation and has substantial built-in gains or losses. In a case like this, converting to a partnership, the cost of liquidating the C corporation and then having to reform as a partnership, that could essentially be prohibitive, right? And then one of the challenges is that you would essentially probably need to have to pay taxes on those built-in gains. So definitely something to think about. Next, we see if special allocations of income, expenses, and cash flows can be made by the entity owners. This would be an advantage of a partnership. E, the entity has taxable losses that the owners can utilize on their individual returns. This would be an advantage of a partnership. If a corporation has a loss, unfortunately, it has no impact on the shareholders in their individual income tax returns. F, if the entity will exist for only a short period of time, if the entity is a C corporation, then they would need to essentially liquidate, and this would result in a large tax due to the appreciation in assets. So this would be an advantage of a partnership versus the C corporation. Next, for G, we have if the entity is in a high-risk business and the owners require protection from personal liability, we know that this is definitely a disadvantage of a partnership, especially with a general partnership, because what essentially happens is that if the partnership doesn't have any money, the creditors, they can come after the partners and hold them liable. Unless, of course, they decide to set up as an LLC, a multi-member LLC, then that helps to shield a bit of protection, or provide rather a bit of protection for the partners. H, we see if the entity plans to lease property from the owners or owners plan on loaning funds to the entity. So this would be a disadvantage of a partnership. Reason being, a partnership in such case will be less advantageous in comparison to a C corporation when the entity can reduce or eliminate its income by paying salaries to the owners. Although obviously the taxpayer, the tax brackets, and the cost of employment should be considered, leasing property from the owners, the rent expense will be deducted, and the owner's corresponding rental income, it could be eligible for the qualified business deduction. Or loaning funds to the entity, again, you will have to factor in the tax brackets, but the business interest deduction limited should be evaluated. So it would be better for the entity to be structured as a C corporation versus a partnership if the entity plans to lease property from the owners or the owners plan to lend funds to the entity. All right, so this brings us to our first question with calculations. So here we see on January 2nd of the current year, Fenton and Myers formed the FMLLC. Their contributions to the LLC are as follows. We have adjusted basis for cash. We have accounts receivable with an adjusted basis of 0, inventory of 25,000, land with a basis for Myers of 250,000. And then we start to look at the fair market value to cash. Fair market value is obviously equivalent to the adjusted basis. Accounts receivable, fair market value is 90,000. The inventory, the fair market value is 60,000. And the land from Myers, the fair market value is 200,000. So it states, FM originally intended to hold the inventory as investment property. Myers held the land as long-term investment property, but FM will use it in its business as Section 1231 asset, as a Section 1231 asset. Within 30 days of formation, FM collects the receivables. 2 years later, FM sells the inventory contributed by Fenton for 60,000 cash. After 3 years, FM sells the land for 200,000. So FM realized the following income in the current year of these transactions. So now it's asking us to figure out, hey, what is the income that needs to be realized in these situations? And for the land, the sale of land, how is that going to be treated? So to answer this question, we have an Excel spreadsheet so we can go through it. All right. All right, perfect. So here we see whenever a partner makes a tax-deferred contribution of an asset to the capital of a partnership, any potential gain or loss recognition is essentially postponed rather than being excluded. So just keep that in mind. It's not like they'll never recognize it. It's just that it's just not recognized right now, right? The contributed assets held by the partnership and the partnership interests held by the partner, they're both assigned a basis that is going to be derived from the partner's contributed property. So it has what's called, a rollover basis. Whatever the basis was from the partner, that's the basis for the partnership. So here in this example, we see for the receivables, the fair market value was 90,000. The basis was 0. So therefore, the realized gain is 90,000 minus 0. So we have a realized gain of 90,000. Next, for the sale of inventory, the fair market value of the inventory was 60,000 and the basis was 25,000. So there's a realized gain of 35,000 in these scenarios. All right, so pretty straightforward. So as it relates to the receivables, there would be ordinary income of 90,000. And for the inventory, there would be ordinary income of 35,000. Now, as it relates to the land, we can see clearly here this would be sale of land. We see that in this case, for the land, the basis is 250,000, but it lets us know that it was sold for 200,000. So in such case, sales price of 200,000 minus the basis of 250,000. In such case, there's a loss. So there's a realized loss. So it could either be a gain or it can be a loss. So in this case, there's a realized loss of $50,000. This would be a capital loss. So here it's saying these rules exist to ensure that a partner and partnership blank property between themselves and alter the inherent character of the underlying deferred income gain or loss. So they cannot transfer property between themselves and alter the inherent character of the underlying deferred income, gain, loss, or deduction. As we know, Uncle Sam don't play that. So they definitely want to make sure that the contributed property, they're not essentially taking advantage of it and not altering the underlying character of the deferred income, gain, loss, or deduction. So we move on to the next question. And here it states, what is the amount of the guaranteed payments made by the partnership this year? B, how much is the partnership's ordinary income after any deduction for guaranteed payments? C, how much will Stella report? And D, how much income will Euclid report? So here it says this year, the Tasty Partnership reported income before guaranteed payments of $92,000. Stella owns a 90% profits interest and works 1,600 hours per year at the business. Euclid owns a 10% profits interest with a basis of $30,000 at the beginning of the tax year and performs no services for the partnership during the year. For services performed during the year, Stella receives a salary of $6,000 per month. Euclid withdrew $10,000 from the partnership during the year as a normal distribution of cash from Tasty. So A is asking, what is the amount of the guaranteed payments made by the partnership this year? So we know one of the key things is that we'll move to A. So a guaranteed payment is a payment to a partner for services performed by the partner or for the use of the partner's capital. A guaranteed payment may not be determined by reference to partnership income. Doesn't matter how much income was made. Guaranteed payments, they're usually expressed as a fixed dollar amount or as a percentage of capital that the partner has invested. So here we see with Euclid, doesn't perform any services or anything for the partnership during the year, and Euclid basically just made a withdrawal. Stella, on the other hand, receives a salary. So the monthly salary amount is $6,000 per month. Oh, an extra zero, $6,000 a month. And we know that in a year, we're assuming, it says during the year, so we assumed a 12-month calendar year. So therefore, 6,000 times 12 months in a year, the guaranteed payment made to Stella is $72,000. So now we move on to B, and B is asking how much is the partnership's ordinary income after any permitted deduction for guaranteed payments. So guaranteed payments, they resemble salary or interest as we see here of interest payments of other business. Deductible guaranteed payments are like any other deductible expense or a partnership, and they can create a loss if it's too much, essentially. So in this case, the income before the guaranteed payments, the problem lets us know was $92,000. And then, hey, we calculated up above that we paid Stella $72,000. So the $72,000 is going to be a deduction. Hence, the partnership's ordinary income is $20,000. Now for part C is asking, all right, well, how much income is Stella going to report? So for Stella, we know that first and foremost, she receives $72,000 for income for guaranteed payments. In addition, she would need to add the partnership's ordinary income. So in the previous problem, we accounted for what the partnership income was. So we saw it in the previous example. Here we see $20,000, as was calculated here. So $20,000. And then we need to determine, well, what is her profit percentage? So here it says she owns a 90% profits interest. So 90%, the partnership share of partnership income is 20,000 times 90%. So we add the two. So it'll be 72,000 plus 18,000. Therefore, for Stella, she will need to report $90,000 worth of income. All right. So again, I want to make sure you guys understand how we calculated the amount is as follows. The guaranteed payment is 72,000. And then from there, you have to add the allocation of the partnership income. The partnership ordinary income is 20,000 as we calculated above, which was the income before guaranteed payments as it states here. And then from there, we subtract the guaranteed payments calculated in part A. So the partnership ordinary income that remains is $20,000. So now moving on to C, a guaranteed payment of 72,000, we add Stella's percentage of the income that is going to be allocated, which we calculated as follows: 20,000 times her 90% profit interest. 18,000 of the 20,000 would be allocated to her. So 72,000 plus 18,000 gives us 90,000. Now it's asking, how much income will Euclid report? Euclid did not receive any guaranteed payments. The partnership ordinary income was 20,000, and it lets us know her profit interest is 10%. So 10%. So therefore, Euclid's share of partnership income to be reported is the 20,000 multiplied by the percentage, which is 10%. So Euclid is going to report $2,000 of income. This brings us to our next problem. Okay, so this brings us to our next problem. And it asks, A, how is the land recorded for 70B book capital account purposes? B, what is Padgett's tax basis in the land? And C, if Padgett sells the land several years later for $300,000, how much tax gain will Nova and Oscar report? Here it states, when Padgett Properties LLC was formed, Nova contributed land value of $200,000 and a basis of $50,000 and $100,000 cash, and Oscar contributed cash of $300,000. Both partners received a 50% interest in partnership profits and capital. So here we see, whenever there's pre-contribution gain or loss, it needs to be allocated among the partners. Reason being, they need to essentially account for it. I'm just going to make some more space. All right, make this a little smaller as well. Perfect. Make this a little smaller as well. Easier on the eyes when you can see everything. All right, so whenever there's a pre-contribution gain or loss, it needs to be allocated among the partners to take into account the variation between the basis of the property as well as its fair market value on the date of the contribution. The partnership is going to be responsible for keeping track of the differences in its 704B accounting records. Whenever there's non-depreciable property, the built-in gain or loss on the date of the contribution, it's going to need to be allocated to the contributing partner when the property is eventually disposed of, all right? So these are some things that you need to keep in mind with a partnership. If the property is depreciable, then regulations describe some of the allowable methods of allocating the depreciation deduction. All right, so we want to determine, again, how is the land recorded for 7OB purposes? So the basis of it is 200,000. As we know, there's a carryover basis. So therefore, Nova's basis becomes Paget's basis. So therefore, Paget would have recorded the land at the basis of 200,000. Now we move on to part B. And part B is asking, what is Paget's tax basis in the land? My apologies. So for A, Paget's book basis is essentially going to be the carryover basis, recording it at the fair market value, which is the 500,000. And then Paget's tax basis, essentially, they're going to take Nova's carryover basis of $50,000. So sorry about that. All right, looking over the question again. So Paget's tax basis would have that carryover basis of 50,000. So for book purposes, they're recorded at the fair market value. For tax purposes, Paget will take Nova's carryover basis. Now for question C, this is basically letting us know that, all right, so they're going to sell it. So here it lets us know we need to account for it under both scenarios. So here's how we would account for it. We see that the amount realized was 300,000. And under book purposes, the amount realized was 300,000. The adjusted basis under book purposes would be 200,000. So the gain realized would be 100,000. But in such case, the built-in gain would not be factored in. So again, these are some of the key things to keep in mind. So we're factoring it in as it relates to Nova and as it relates to Oscar. So if the land is sold for 300,000, Nova is going to need to report a $200,000 gain, and Oscar would have a gain of $50,000 because, again, we had that pre-contribution gain of $150,000. But again, it wasn't accounted for book purposes, but it is accounted for tax purposes. So the built-in gain to Nova, none under book purposes. So the remaining gain of 100,000 is going to be allocated to each. But now we look at it for tax purposes and how it would be treated. So under tax purposes, the amount realized is 300,000, sorry. The adjusted basis is 50,000. That gives us gain realized of 250,000. And from there, we need to factor in the built-in gain to Nova. So Nova contributed this property, this land, which had a basis of 50,000 and a fair market value is 200,000. So there's a built-in gain of 150,000. 200,000 minus the 50,000, there's a built-in gain of $150,000. So in such case, it's the gain realized minus the built-in gain to Nova that Nova would need to account for. And then this $100,000 would be allocated to each partner. So in such case, Nova is going to need to calculate for income as follows. So Nova and I'm just going to abbreviate, Nova has the built-in gain plus share of gain. So Nova's built-in gain is 150,000. And then this $100,000 gain is going to be allocated to each partner. So 100,000 times 50% is 50,000. So therefore, Nova needs to recognize a gain of $200,000. So Nova reports a $200,000 gain, and Oscar's gain is going to be 50,000. So Oscar has no built-in gain, 0, but he does need to account for a share of the gain of 100,000. 50. So therefore, 200,000 represents the built-in gain for Nova, or the gain for Nova, 150,000, which represents the built-in gain. The $50,000 basis in the land contributed at 200,000 plus her share of the gain. Oscar, on the other hand, has no built-in gain, but his share of the gain would be $50,000. All right, so we're gonna move on to our next question. Just gonna format this a bit. All right, so we move on to our next question. Here it asks or states, how much is Barnaby's basis at the end of the tax year? At the beginning of the tax year, Barnaby's basis in the BBB partnership was $50,000, including his $5,000 share of partnership debt. At the end of the tax year, his share of debt was $8,000. His share of the partnership income for the year was $20,000, and he received cash distributions totaling $12,000. In addition, his share of the partnership's non-taxable income was $1,000. So here's how we factor it in. So we start off, well, what was his basis at the beginning of the year? So here we see the basis at the beginning of the year was $50,000. Next from there, well, what's the increase in the share of the partnership debt? Well, we need to really figure that out. What's going on? So the ending balance for the partnership debt was $8,000. The beginning balance was $5,000. So here it says including $5,000 share of partnership debt. So the beginning balance was $5,000. We want to figure out what was the increase or the decrease in the share of partnership debt. So $8,000, which represents the ending balance, minus the beginning balance of $5,000, lets us know that there's a $3,000 increase in the share of the partnership debt. The increase in the share of partnership debt is going to be added. Next from there, we need to factor in, well, what was the partnership income? It lets us know that his share of the partnership income was $20,000. This amount is going to be added. It also tells us that there's some non-taxable income of $1,000 that is going to be added. And then it lets us know that he received a cash distribution of $12,000. So this distribution is going to decrease his basis. So therefore, his ending basis would be as follows. His beginning basis of $50,000. We would add his increase in the share of partnership debt. How did we determine that? We factored in, okay, at the beginning of the year, he had $5,000 share of partnership debt. And at the end of the year, his partnership debt was $8,000. So we determined that there was an increase, much like if we think about it like a bank account. If your bank account at the beginning of the month has $5,000, and now at the end of the month, the ending balance is $8,000, there was an increase of $3,000. So we factored in that $3,000. The problem lets us know that his share of partnership income was $20,000. There was tax-exempt income of $1,000, and he took a distribution of $12,000. So therefore, the ending basis for Barnaby is $62,000. This brings us to our next question. Here it states, how much of the non-recourse debt is allocated to Jocan? What is the amount of Jocan's basis in the LLC interest following the contribution? Jocan contributes a non-depreciable asset to Mahali LLC in exchange for a 1/4, 25% interest in the LLC's capital and profits, and a 30% interest in the LLC's losses. The asset has an adjusted tax basis to Jocan, and the LLC is $60,000 and a fair market value of Section 704B, book basis on a contribution date of $150,000. The asset is encumbered by a non-recourse note of $40,000 that has not been guaranteed by any of the LLC members. How much of this non-recourse debt is allocated to him? And what is the amount of his basis in the LLC interest? So in order for us to determine how to answer these questions, Here we see in general, disregarding any personal guarantees, recourse debt is allocated among the general partners only, and non-recourse debt, which includes qualified non-recourse financing, and is allocated among the partners. And for our purposes, it's allocated to the partners in accordance with their profit sharing ratios. Basis, as we know, is increased for contributions to the partnership, and it's decreased by debt assumed by the partnership on behalf of the partner, and increased by the partner's share of partnership debt. So if we look at this question, we see, again, what's going on here? Debt assumed by the LLC, as the problem lets us know, is $150,000. Oh, sorry. Here we see the debt, sorry, is $40,000. So the debt assumed by the LLC is $40,000. And it lets us know that Joe Kahn has a 25% interest. So based on that, the partner's percentage, which is 25%, the partner's share of debt is 40,000 times 25%. So therefore, $10,000 of the debt is going to be allocated to Joe Kahn. Now it's asking, what is the amount of his basis in the LLC interest following the contribution? So here we see his basis is first 60,000. Here it says the asset has an adjusted basis to him of 60,000. But then the partnership essentially assumes the debt of 40,000. So the beginning basis was the 60,000, but the partnership accounted for $40,000 of the debt. So as we see here, the basis is increased for contributions, decreased by the debt assumed by the partnership, and increased by the partner's share of the partnership debt. So as we calculated above, Joe Kahn's share of the debt is 10,000. So therefore, the ending basis is the beginning basis less the debt assumed by the LLC, and add his basis of the debt. So therefore, the ending basis for Joe Kahn is $30,000. And this brings us to our next question. Here it asks, how much of Solomon's losses may Tobias deduct on his Form 1040? How much of the loss is suspended? And what code provisions cause the suspensions? All right, so in this case, it says Tobias is a 50% partner in Solomon LLC, which does not invest in real estate. And then it's letting us know what's happening. On January 1st, it states Tobias's adjusted basis for his LLC interest is $130,000 and his at-risk amount is $105,000. His share of losses from Solomon for the current year is $150,000, all of which is passive. Tobias owns another investment that produced $90,000 of passive activity income during the year. Assume that Tobias is a single taxpayer. There were no distributions or changes in liabilities during the year, and the Solomon loss is Tobias's only loss for the year from the activity. So here we have these several losses that take place. So that's one of the things as it relates to a partnership, right? There are different ways in which losses are allocated and the way in which it is treated, ultimately depending on the basis in the partnership. So in this case, we need to account for these applicable provisions. We have what's called Section 40D, 704D rather, which denotes the overall limitation. We have Section 465, which is the at-risk limitation. Section 469, which is the passive loss limitation. And we need to determine how much of the loss is considered deductible, and then how much of the loss is going to be suspended. So in this case, here we see. So the first thing we need to factor in is how much the loss is. So we see that in such case, there was an overall loss of $150,000. But one thing we know is, what is his overall loss? It says that he has a basis of $130,000. So therefore, because the partnership losses flow through to the partners, and again, they're going to be reported on their tax returns, the loss deduction may be limited at the partner level, as we see here. So whenever these limitations apply, all or a portion of these losses are going to be suspended until there's a triggering event, as we see in this case. So the overall loss was $150,000. However, he only has a basis of $130,000. So with this, Section 704D, this limitation allows a loss deduction only to the extent of the partner's adjusted outside basis. So of the $150,000 loss, $130,000 is deducted. And let me actually add another. So here we have total loss. So the total loss is $150,000. But again, it is limited to his basis in the LLC in this case, right? Partnership LLC, same thing. It's multi-member, treated like a partnership. So of it, the suspended loss would be the total loss minus the amount that is allowed to be deductible, which is $20,000. Next, we move on to at-risk limitation, section 465. Losses that are deductible under the basis limitation are deductible only to the extent that the partner is at risk for the partnership loss. So here it says his at-risk amount is $105,000. So based on that, the total amount, again, his basis is $130,000. But as it relates to 465, his at-risk loss amount is $105,000. So therefore, the suspended loss under these rules is $130,000 minus $125,000. The suspended loss would be $25,000. Next, we move on to the section 469 passive loss limitation. So any losses that survive this second limitation may be subjected to the passive activity loss rules. And in this case, he has this investment of $90,000. And this would be for, based on his total at risk. So $105,000. There's a deductible loss, and it says Tobias owns another investment that produced $90,000 of passive activity income. So with the passive income, that passive income can absorb $90,000 of the passive loss. However, that leaves $15,000 as suspended. So again, obviously, there's a lot of nuance that goes into loss limitations and how it relates to deducting partnership losses. So there are those 4 rules, and they apply in the order shown. Basis limitation, which is governed by Section 704D. At-risk limitation, which is governed by Section 465. Passive activity loss limitation, which is governed by Section 469. And excess business losses, which is subjected to Section 461. All right, so I'll update these. This is the correct order. All right, so I just, type in the information that we calculated here. The deductible loss is $130,000. Suspended is $20,000. The at-risk loss, $130,000. But then again, $105,000, which is based on his risk. So $25,000 is suspended. The passive loss limitation, $90,000, would be offset by the $90,000 income, but then $15,000 would be suspended. So based on this information, now we need to determine, well, how much can he deduct? So based on going through all of these rules, he can only deduct $90,000 on his return in the current year. All right, so this brings us to our last question for Chapter 9, Partnership Formation, Operation, and Business. Here it states, how much gain or loss, if any, does Shauna realize on a transfer? Does Shauna recognize any gain or loss? If so, how much? B, What is Kanisha's tax basis in her LLC interest? C, what is Shauna's tax basis in her LLC interest? And D, what tax basis does the LLC take in the property transferred by Shauna? Here it states, Kanisha and Shauna formed the Equal KS LLC with a cash contribution of $360,000 from Kanisha and a property contribution adjusted basis of $380,000, fair market value of $360,000 from Shauna. So it's asking, how much gain or loss, if any, does Shauna realize on the transfer? So let's see here. There's an adjusted basis of $380,000, and the fair market value is $360,000. So based on that, Shauna has a realized loss of $20,000. And in this case, none of it is going to be recognized. So as we know, as we've learned, when a partnership is formed, the partners contribute cash and other property in exchange for the partnership interest. The transaction has implications for both the partners and the partnership. However, Congress intended for partnership formation transactions. Obviously, they want it to be tax neutral because think about Section 351, same thing. Individuals, if every time they contributed property that appreciated in value and it was going to be subjected to taxes, nobody would want to form a corporation, right? So in this case, Shauna has a realized loss of $20,000. None of it is going to be recognized, and recognized basically means that it is reported for tax purposes. But again, under these rules, Section 721, it contains the general rule that there's no gain, no loss recognized to a partnership or to partners. And again, she is subjected to this rule, hence she won't recognize the loss. B asks, what is Kanisha's tax basis in her LLC interest? Based on this, the 704B book basis is going to be the fair market value. So $360,000, her tax basis in the LLC, and her 704 book basis is going to be the same, $360,000. C asks, what is Shauna's tax basis in her LLC interest? So Shauna's tax basis in the LLC is going to be $380,000. And the 704B book basis is going to be $360,000. All right. So here we see Kanisha contributed cash, $360,000. The book basis is equivalent, $360,000. And Shauna contributed the property, which has a basis, the tax basis, again, which is the carryover, which is the adjusted basis. And the book basis is based on the fair market value, which is $360,000. And then this brings us to the last one, and it asks, what tax basis does the LLC take in the property transferred by Shauna? And as we saw in the previous problem, the partnership takes on the individuals, the partner or the member. In this case, it takes on their adjusted basis, which for Shauna is $380,000. So this basis carries over to the LLC. And now the last part of the question asks, how could this transaction be restructured to maximize the tax benefits to Shauna? Because obviously there's a loss on the property. So what Shauna could do, there are no other effective ways to structure formation. Not true. Contribute a different property that would generate a loss. No, that's basically what we're trying to avoid. Sell a different property that would generate a gain and contribute cash. No, what if she doesn't have another property? What would make the most sense is to sell the property to an unrelated party and then contribute the cash. All right, so this brings us to the end of several questions for Chapter 9, Partnerships, Formation, Operation, and Basis.